What are the best ways to withhold for taxes when you're in retirement? When you step away from that paycheck, you step away from traditional tax withholdings. How do you withhold for taxes in retirement? I've got the top 3 ways. That more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, you've worked all your career saving up, sacrificing, working hard to someday safely, confidently step away from that paycheck and enter retirement. Feels so good. Until you notice that is an enormous change on your taxes and you want to make sure you avoid a big tax surprise. How do you pay in the right amount of taxes when you step away from your paycheck? Because while you're working, all you need to do is fill out a W-4, the most confusing form ever, and that will set up your withholding so that you have taxes withheld on your income and you show up and get your tax return done, and hopefully you've been doing tax planning along the way. You've captured opportunities, you have no surprises, and you're all taken care of. When you step away from that paycheck, you step away from that steady withholding system as well. Your income is going to come from different sources and can be erratic, where some years it will be very different than other years. And if you don't have proper withholding techniques, it can create significant challenges with your taxes. Many people think, while I'm working, I'm earning all this income and I've got, kids I'm raising and college expenses and all these tax incentives that are out there. I bet my taxes are pretty confusing. Compared to retirement, it'll be so easy. I'm not working, it'll be a piece of cake. The opposite's true. Yeah, you've got some complexity while you're working, especially if you own business and you've got kids and all that. That's just a little bit of tax planning. You don't have a lot of choice there. In retirement, you've got tons of choice. When do you turn on Social Security? How should you take your pension? Should you withdraw from your IRA or your Roth? How much should you withdraw? Should you take So lots of changes that will impact your tax withholdings and your tax planning in retirement. It's even more important at that stage. So no one likes to pay tax estimates. That's, of course, one way that you can handle all your taxes. Most people, though, would rather do tax withholdings. What are the top 3 ways to manage your tax withholdings in retirement? So the first, and it's not the eye-opening strategy that I'm going to share in just a second, but it's one that we use a lot, and that is doing a tax projection for your retirement, for each year in your retirement, where you're looking at, here's how much Social Security, here's how much dividend income, here's how much pension income, blah, blah, blah. Here's how much you'll be withdrawing from your IRA. And then here's your standard deduction, here's the amount of tax that you'll have. Let's structure it so that you withhold all of your taxes from your IRA withdrawals. If you're needing to withdraw or you're needing $1,000 from your IRA to supplement your income, but when we do your tax projection, you're going to have to come up with an extra $6,000 of tax, take out $1,500 from your IRA and withhold $500 to cover all of the income tax you're going to need, and then you've got your $1,000 net each month, and you've covered all your tax withholding from your IRA. Those are simplistic numbers, likely a lot smaller than what they would normally be in your situation, but the premise is do a full tax analysis, a full tax projection to see here's all the sources of income we're going to have, here's our deductions, here's what the tax will be. Okay, if the tax is X amount of money, divide that by 12 and have that come out of your IRA every single month along with the amount you're withdrawing to supplement your income, and withhold it for taxes. So why do I like that idea? You've got a lot of flexibility when something changes. We're taking an extra vacation, so we need an extra 10 grand, or we're not needing as much withdrawals this year, something like that. You can easily adapt because your withholdings are based on how much you're drawing out of your IRA, just proportionate to your overall tax projection and tax plan. With the IRA, one of the things I like about that compared to the 401k, got a lot of flexibility as to how much you want to withhold, whether you want to withhold for state. I mean, truly, this could mean you're in the you find yourself in the 12% tax bracket, but because your other sources of income don't have withholdings or the right level of withholdings, on your IRA you're withholding 30% or 25% just to cover the withholdings on all sources of income. We do this all the time for clients. It makes a lot of sense. Second way to manage tax withholdings in retirement is setting up so that you've got tax withholdings on your Social Security. Now, I even have to just pause to say that because Social Security, it is more complicated than it should be to withhold taxes on your Social Security. Okay, it's almost like Social Security Administration doesn't want you to know it's taxable. For some people, it isn't. It's whether your Social Security is taxable or not depends on all of your other income sources and whether it reaches a high enough level. And when I say high enough level, I'm not talking a big amount. It's actually pretty small. You get, all of your other income plus half your Social Security. If it's above this number, then your Social Security is going to start becoming taxable. It's almost like the Social Security Administration wants to hide that or ignore that. For example, meeting with some new folks who are retiring this year. And after one of our meetings, one of her action items was to, sign up for Social Security. We'd done the analysis. She was going to start. And I said, you can do so online. You can set up a phone interview and consultation. They're going to want you to do it online, though. And I said, but in your situation, now hear me. You've got a pension. Your spouse has a pension, your spouse has Social Security, and we know you're going to be drawing about $1,000 out of your IRA every year. You're going to pay the maximum amount of tax on your Social Security every year. Basically, your Social Security, 85% of it, most of it, is going to be taxable income. Therefore, you should have taxes withheld from your Social Security. So I made that very clear, but it's going to be difficult for you to find out how to do this. So just be careful as you're going through the application on the Social Security website. Be careful, be on careful lookout to find out where you can add tax withholdings. We talked about this. I sent her an email about it. The next day she sends me an email back and says, I scoured that thing and I never found where I could elect to have taxes withheld from my Social Security. And I didn't go through it with her. We don't sit with clients and have them kind of check all the boxes, go through all the steps with us together. So I haven't seen it, and I know they've made some updates to the system. That's baffling to me that someone that's highly intelligent and knows that they need to withhold taxes, income taxes on their Social Security, and was already forewarned it's going to be hard to find. So be on the lookout, be a detective. Couldn't find it. So what do? I had to send her the link to the form. You can find it in Google. I'll put a link in the description below. Basically, you can fill out a form, a voluntary request to have taxes withheld. They allow you to withhold 7%, 12%, I believe, and a few others, okay? But you can withhold taxes from your Social Security. I do not think it'd be appropriate to consistently withhold taxes from your Social Security if very rarely Social Security will be taxable for you. I would only do it if you're in a situation where, listen, you're going to be withdrawing this much consistently out of your IRA to meet your lifestyle. You've got pensions or whatever. You've got other income. Basically, that tax projection that I mentioned in step one, that tax projection, it's going to show that you're going to have your Social Security is going to be taxable pretty much every year. If that's the case, then I would withhold. If that's not the case, I wouldn't withhold taxes on your Social Security. I would revert back to step one, and that is I'd withhold it from the IRA as well. Now, the third way that we would recommend you consider withholding taxes in retirement. This one is the unique strategy, and you've got to be very careful. Make sure you're doing this with a certified financial planner who's familiar with this strategy, can help walk you through it, and my goodness, who's doing comprehensive financial planning and tax planning, okay? And that is once a year, calculating how much tax you think needs to be withheld. So basically doing that tax projection once a year in the fall, taking a withdrawal from your IRA and withholding all of it towards taxes. Taking the money out of your IRA but withholding 100% of it. And then using the money that you've accumulated in your bank account or in your checking account and contributing that money back into your IRA within 60 days. That turns that withholding, that withdrawal from your IRA, and negates it from being taxable because you've replenished the account within 60 days as a 60-day rollover. For example, you do all the math and you've got cash flow coming in, but you've never withheld any taxes all year. You've been saving it up in the bank account. You sit down with your certified financial planner who's doing tax planning and financial planning, and they say, yeah, you're gonna owe about 10 grand in taxes. You should have 10,000 paid in. Instead of writing an estimated payment for 10 grand and just paying that once because there'd be penalties, you weren't doing it every quarter. Take that 10 grand, withdraw it from your IRA and withhold all of it towards taxes. And then take your checkbook and write a check or make a contribution back into that IRA for that 10 grand. It's not a contribution meaning that it's deducted. It's a 60-day rollover as long as you get it done within 60 days. Here's the trick. You've got to make sure you only do one of these every 12 months. and it's for all of your IRAs. You can't do it from this one IRA and then 3 months later do it from another IRA. All of your IRAs are aggregated together, and you can only do a 60-day rollover once every 12 months. Not once a year, once every 12 months. So you would only consider this if the likelihood of you needing to do a 60-day rollover is basically none. If there was no chance of that, and there was enough variability in your tax payments that it really would be cumbersome to pay estimates, which most people don't like paying estimates. And there's enough variability in, oh, I need an extra $5,000, or I need an extra this, or I don't need this much, whatever, that each year it makes sense to recalculate what your tax projection is and then pay those withholdings right out of your IRA and take the money that you were going to pay to the IRS, put it back in your IRA as a 60-day rollover. So those are our 3 favorite ways to manage taxes, do tax withholding in retirement. First 2 fairly easy, but it's going to take some proactive tax planning. The third way, more strategic, more creative. Work with a certified financial planner. See if any of these or all of these 3 ideas make sense in your situation. Work with your CFP. They've got to be certified. They've got to be doing comprehensive financial planning. They've got to be doing tax planning as well. Otherwise, they're not really going to be able to guide you through this with expertise. If you don't have a CFP like that on your team, you can contact one of my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.